Wall Street may just be starting to wake up to the fact that the proposed acquisition of Warner Brothers Discovery by Netflix isn't going to go exactly the way they hoped, or maybe not go at all. If you take a look at this chart here, probably gives you a pretty good indication of what Wall Street is concerned with right now, considering that Netflix is down about 38% in the last 6 months. Even with a recent earnings report from Netflix that was, frankly, quite great, it still wasn't enough to get over the fact that, well, Wall Street still has a ton of concern over how far this fight for Warner Brothers could drag out. And now Paramount is doing what Paramount does best, changing the rules of the game. And one thing seems for certain at this point: the pendulum is swinging in the Ellisons' favor. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see all of you out there once again. And if you are like one of the many watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker around on the social medias, and of course, please do leave a comment before you head out the door today. Make sure to join us every Sunday afternoon right here at 6 p.m. Eastern for the live show. Anybody out there who still thought this was a done deal is still sadly mistaken. And this just happened a couple of days ago. Paramount has sweetened their hostile takeover bid for Warner Brothers Discovery, and the Warner Brothers Discovery board has agreed to review this new offer. Now, if you recall, up to this point, the fight between Paramount and Warner Brothers and Netflix has grown quite contentious, particularly between Warner Brothers and Paramount, with the Ellisons slinging around accusations that Warner Brothers really didn't give their offer a fair look. The board didn't do a proper review before recommending the Netflix deal to shareholders, which is why David Ellison, and by extension his father, Larry Ellison, the founder of Oracle and the multi-billionaire that's backing this sucker, well, that's why they have decided to go directly to shareholders in this case to take their case to them. And as we're about to find out, there are more and more of them coming over to Paramount's side. This from ThatParkPlace.com. The high-stakes media consolidation battle surrounding Warner Brothers Discovery took another dramatic turn this week, as Paramount Skydance formally upgraded the financial terms of its hostile takeover bid, escalating pressure on WBD leadership as it weighs competing offers from Paramount and Netflix. Paramount's revised proposal introduces significant new incentives aimed directly at Warner Brothers Discovery shareholders, including a quarterly cash ticking fee designed to compensate investors if regulatory or transactional delays push the deal timeline further out. This portion of the upgraded offer directly addresses the concerns of major shareholders of a protracted regulatory battle with the federal government, especially if Netflix should proceed on course, which could drag out quite some time. What Paramount is trying to do is assure shareholders that they will be able to complete their acquisition of the entire company, not just a portion of it like Netflix is proposing, in a very timely manner. What the ticking fee does is add a 25 cents per share booster to the $30 a share price that Paramount is currently offering for the whole kit and caboodle for every quarter that the deal takes beyond January of 2027. That's a very aggressive timeline, and that's probably not a figure that Paramount would just drop on the table like that if they didn't feel exceptionally confident that they could get it done.
But wait, there's more.
Another big addition right here is a $2.8 billion promise by Paramount and the Ellisons to cover the termination fee with Netflix if they take the Paramount deal. Something else that Warner Brothers Discovery shareholders are probably very happy about, and it's going to make their decision a lot easier. Now, Paramount has also agreed to extend some additional assistance with various debt consolidations, refinancing of corporate debt, so on and so forth. All of these are little bits and pieces to keep adding to the pile, to keep reassuring Warner Brothers shareholders that, hey, look, the water is just fine over here at Paramount. Come give us another look. Now, that $30 a share with a potential 25 cents per share escalator per quarter that it doesn't land on time, at least in the time frame that Paramount is offering from January 2027. And it really already was over the top of the Netflix deal. $27.75 per share is what Netflix was offering, again, just for the film and television studios packaged in with HBO Max, the streaming service. It didn't include the linear assets like CNN and whatnot that are going to be spun off into their own separate media company. Paramount is offering that bonus up to $30 to get the whole thing. And right now, there's probably a lot of shareholders that are paying attention to this that are looking at that clearly as the better deal. And there's more and more of them moving over to Paramount's side. Think about this. There's no guarantee, once again, as we've mentioned before, of what value the market is going to place on a spun-off company once it goes public. Look at what's going on right now with Comcast and Versant. It's not exactly everything that they had hoped for. Now we're talking about a year from now, potentially 2 years from now, before a spinoff may finally settle, depending on the regulatory environment they have to go through with the federal government. That means another year of cord cutting, another year of lost subscribers, lost revenue, lost advertising. If they're thinking that that might be worth $4 to $5 now, good luck 12 to 18 months from now.
Give me money, money me, money now. Me a money needing a lot now.
And again, all of this elicited an affirmative response from the Warner Brothers board saying that they will now formally evaluate the updated proposal from Paramount, but it emphasized that no recommendation changes have been made at this stage. And Wall Street does indeed acknowledge the biggest problem to the Netflix and Warner Brothers merger is the regulatory environment. It is the federal government. And that is probably playing a heavy hand on why the Netflix stock price has gone down so much since they announced they wanted Warner Brothers. Down over 35% just in the last few months since this started. And to make matters worse, this is the same 6-month period for Netflix compared to the S&P 500, for which Netflix is very much in the S&P 500. The S&P is up 7.21% over the same 6-month period that Netflix has fallen over 35. In other words, this isn't something related to strictly a broader market pressure. This is overwhelmingly on Netflix. And to make matters worse, a new player has entered the game. Ancora Capital builds a stake in Warner Brothers and plans to oppose a Netflix deal. Ancora currently has a stake of around $200 million in the HBO owner and said on Wednesday that Warner Brothers board has not adequately engaged in talks with Paramount Skydance over a rival offer for the whole company, including cable assets such as CNN and TNT. The currently proposed Netflix WBD deal asks shareholders to accept inferior value, gamble on an uncertain spinoff, and shoulder significant regulatory risk, despite the availability of a higher value and more certain $30 per share from Paramount, the activist investor said on his website. Now, granted, a $200 million stake in a nearly $70 billion company right now, at least as the market cap stands for Warner Brothers since all of this began, is not a whole lot, but it is something. And it is somebody who is making noise and is looking to acquire more shares. And this is one of those activist investors that are actually paying attention to what's going on at the company. Somebody that actually wants to get the highest return for their money and for their clients as they possibly can. Matter of fact, our old buddy Nelson Peltz spoke on this just recently at a Wall Street Journal summit.
What I think the real issue is the index funds. They are the only shareholder who really doesn't care if the stock goes up or down. That's a problem because they're the biggest shareholders. And that 25% becomes 30, 35% because everybody doesn't vote, but they do. So they really swing the cat around the room and they don't have a dog in the hunt.
Passively managed funds and ETFs that control trillions and trillions of dollars of American invested assets that have S&P 500 funds or NASDAQ 100 funds. Nelson Peltz is exactly right. They're not in it because they made an active decision to go pick up something like a Warner Brothers Discovery or a Netflix or what have you. They're simply holding it in these particular funds because that stock happens to be part of the NASDAQ 100 or part of the S&P 500. The activist investor is actually trying to make a money play by actively selecting a stock they think is going to outperform the broader market and that they can have some kind of control over. Maybe Nelson Peltz has a point there. Maybe we should reevaluate these passive investments like passive index funds still being able to retain so much voting power over companies like Disney, Warner Brothers, Netflix, and go on down the list. And if you want a very succinct breakdown of everything that's happened up to this point, I'm going to suggest this Wall Street Journal article here where the battle for Warner Brothers stands now. This was just published in the last couple of days. But MarketWatch and others understand what's going on, and they're finally starting to call it out. Warner Brothers shareholders are getting restless in this Paramount-Netflix bidding war. With a shareholder vote likely on the horizon, Paramount Skydance is unrelenting in its hostile tender offer to woo Warner Brothers Discovery investors away from rival bidder Netflix. The question is now how impatient large Warner Brothers Discovery investors will become with the board, especially considering Paramount offered them more for the Warner Brothers shares they recently purchased after Netflix announced its bid. In normal times, a corporate board focuses on long-term strategy, improving a company's chances of surviving and competing over many years. Courts presume that this forward-looking stewardship ultimately benefits investors. But the calculus changes once a company is put up for sale. At that point, the board's legal duty narrows, and its main obligation becomes maximizing shareholder value. Paramount's hostile takeover bid bypasses management entirely, appealing directly to investors and potentially putting shareholders' preferences at odds with the board's preferred transaction. To put it simply, the ultimate goal and the ultimate fiduciary responsibility of a board of directors on a publicly traded company like Warner Brothers at this point in time, with a pending sale hanging in the wind, their job is to make sure that they get the highest amount of value for shareholders, period. If they fail to do that, or they're found to have ignored a better offer in favor of a preferred suitor, they might have legal problems later. And this is where the rubber meets the road. The BlackRock event-driven equity fund, for example, has increased its Warner Brothers holdings by 374% as of year-end, while the Vanguard Windsor II fund increased its holdings by 15%. And I want to point out, we're not talking about the passively managed index funds of a BlackRock or a Vanguard. These are actively managed funds where they're picking up Warner Brothers shares in excess because they believe a deal is imminent and they can capture a fast upside return, picking up the shares now and hoping they do come in at an even higher price within the next few months. Oakmark owns about 3.8% of Warner Brothers' outstanding shares, and they said that they are pleased with the steps the Warner Brothers board has taken thus far to unlock shareholder value. We'll continue to closely monitor developments as this bidding war unfolds. And of course, that goes back to the conversations we've had before where David Zaslav is not a stupid guy, and he knows if he can squeeze more and more concession out of David Ellison, well, he's going to do it.
Give me money.
On January 20th, investor David Einhorn wrote in a letter to his firm's investors that his Greenlight Capital bought Warner Brothers because of the dueling offers. They're waiting for a deal to settle with an expected final share price in the low to mid-30s. That's the Paramount number. Both Oakmark and Greenlight sound like sellers. This type of investor cares about the spread between the bid, meaning what they paid for it, and the final price that they'll get when Warner Brothers sells. They also care about regulatory risk. They don't want long court battles. So to the more active investors out there picking up swaths of new shares of Warner Brothers stock, the longer the regulatory fight with the federal government drags out, regardless of the ultimate suitor, is bad for them. It lowers their return. It increases their risk. And that's not something they're in a game for with their clients. So they want this to get done quickly. And right now, as I said earlier, the pendulum is swinging in Paramount's favor. The New York Post's Charlie Gasparino reported earlier this month that Warner Brothers' David Zaslav wants Paramount to sweeten its $30 bid. To get them to do that, he filed paperwork for an expedited proxy vote to approve Netflix's $72 billion offer. Paramount is unlikely to increase its number. Gasparino's take is that filing for an expedited proxy vote is about pressuring Paramount and its deal partners at Redbird Capital to provide more financial guarantees. It seems like that's exactly what they did earlier this week. So we'll see what happens. But the problem is you've already got a lot of these shareholders not on board all the way with the Netflix deal, starting to move over to the Paramount column. At this point, David Ellison may not have to do much more than sit and wait for them to come over. The fact that Paramount's offers for the entire company, meanwhile, signals that their deal might lead to a quicker closing for investors. Paramount this week extended the deadline of its tender offer to March 2nd. If enough shareholders tender at $30, Paramount could gain a larger stake in Warner Brothers and force the board into a fiduciary dilemma. And that dilemma may already have a name, as you can see here. Paramount looks to have selected somebody, or at least have somebody on deck, that should they be able to acquire enough of a voting power from tendered shares during this proxy fight, well, they might force a board seat that favors Paramount. The name of that dilemma specifically is Matthew Halbauer, the founder of Pentwater Capital Management. And he may be tapped to be a potential director candidate later this year if the company pursues a board fight at Warner Brothers, he confirmed to Reuters. And why David Halbauer? Well, Pentwater, the company that he runs, is the 7th largest investor in Warner Brothers, with about 50 million shares. News that Halbauer, who has expressed support for Paramount's bid to buy Warner Brothers, might be a candidate, was first reported by the Financial Times. It also signals a further escalation of tensions after another hedge fund, Ancora Holdings, which said it has established a position in Warner Brothers, voiced disapproval of the Netflix deal and might run its own proxy contest. Like I said earlier, this battle is long from being done, and it's certainly long from landing in Netflix's lap. There's way more to go. And just in the last few weeks, we saw Ted Sarandos, one of the CEOs of Netflix, sitting before a congressional panel testifying about the particulars of this proposed merger and acquisition. And we heard Ted talking about how they would honor a 45-day window in theatrical, and all that sounds well and good, but I don't know how long that would really last if Warner Brothers wound up in the hands of Netflix. Let's assume for a minute they do continue a 45-day theatrical window, but then it would go straight to Netflix after that, would it not? Would Netflix still honor things like premium video on demand windowing of 30 to 60 days? Would they still honor physical media or even still make physical media for any Warner Brothers titles at that point? A lot of those pay windows disappear and fall off the map, things that are very lucrative. And the problem that Wall Street continues to seem to ignore is asking the question of Netflix in this case, where they perceive nearly $70 billion of value if they're going to collapse all this onto Netflix. Again, somebody explain this to me like I'm 3 years old, please. If we're going to eventually cut out theatrical, if we are going to eventually absorb HBO Max into Netflix, well, if HBO Max is $20 a month and Netflix is $20 a month, are we now going to have a Netflix service that's $40 a month? Much of the value in what they're paying for with Warner Brothers right now is in film. It's in television. It's in broadcast. It's in live sports. It's in a lot of things that, well, Warner Brothers is effectively going to spin off if Netflix takes it and put TNT in its own little box over there. And like I said, physical media and everything else, what are we going to do? Are we going to nix the HBO subscription for $15 or $10 or $20 a month? Are we just going to get rid of that altogether? Where does the value go? What is Netflix actually buying here once they acquire Warner Brothers? Are they going to strip it basically of all the sources of revenue that it has now and spend $70 billion to ultimately wind up with nothing but a giant pile of intellectual property?
50 interconnected Mega Minion stories shared across a variety of mediums for the next 100 years.
I don't care who you are. This is a problem. It's a big problem for Netflix. And even after several very good earnings reports the last 2 quarters, record profits, record profit margins. In fact, Netflix, with less than half the total revenue of the Walt Disney Company, is producing more dollar profit than the Walt Disney Company. It's firing on all cylinders right now. So why is the stock doing this? the only possible answer is this deal with Warner Brothers is finally starting to smell as rotten as it always was. But I guess maybe Greg and Ted used some really good air freshener that's finally worn off. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.